Okay, this is going to be chapter 10 slides, part 3, which should be the last part. All right, so, we're doing cost recovery. We are recovering the cost of our assets, right, with multi-year lives. And we said, right, businesses, even cash method businesses, have to capitalize those assets and recover the cost over time through depreciation, most commonly, except when they don't, right? Now we're going to find out about some pretty big exceptions that let us deduct a lot of these assets right away, all in the first year. All right, so one provision of the tax code, right, it's in section 179 of the Internal Revenue Code. It's called, we mostly refer to it as section 179 expense. It's called immediate expensing. All right, basically what's happening most of the time here is businesses are lobbying Congress. Congress is trying to stimulate the economy, right? We're going to see a lot of this type of stuff happening now, right? And so they let businesses deduct things right away, right? They're going to deduct the same dollar amount total, but by being able to deduct it all up front, right, the time value of money makes the business save a lot of money, right? And the idea is that they'll go out and they'll buy more assets, and that gets the economy going. Bonus depreciation is another way where, right, the section 179 expense is sort of permanent, although they change the numbers a lot. Bonus depreciation is a separate thing that comes and goes, right? But so right now we have bonus depreciation that was created as part of the last big tax law, Tax Cuts and Jobs Act. All right, so first section 179 expense, it's a little more complicated. All right, so this is only, right, the idea is to encourage people to buy assets. All right, so you can only get this deduction in the year that you buy something. If you already bought it in the past, right, then, and didn't take the deduction, then, right, that's not what it's for. It has to be, right, certain assets are eligible. So it's got to be tangible personal property, right? Personal means it's not real property, but it has to be used in a business. It could be off-the-shelf software and certain real property improvements used in a trade or business. So this is not an actual building itself, definitely not land, right? But it's going to be things like maybe a new air conditioning system, right? A new water feature in your restaurant lobby, something like that, right? New tile floor. These are things that can be depreciated and even eligible for immediate expensing. So if it's one of these assets, right, which is most assets, then you can take your 179 expense in year one, right, just an extra big chunk of depreciation. Then if there's any basis left, you take that basis times the percentage that you get from the regular makers tables like we've been doing. So the 179 amount, right, this started in 2003 after 9/11 and the dot-com bubble. It kind of went up and up, right, after the financial crisis, and the tax reform made it permanent at $1 million, but it's indexed to inflation, so it goes up. It's for 2019, right, tax year, which we're dealing with in our class, it's $1,020,000. For 2020, it'll be $1,040,000. Okay, so 1,020,000 is the number we want to remember. So suppose Brickman Incorporated buys a machine that costs $1.13 million. A machine, if you remember, right, we could look up from our little table, it's 7-year property. They bought it and placed it in service on February 15th. They want to get the maximum deduction that they can. So what will their cost recovery be for this machine? right? If you remember, right, their original basis, their cost is 1.13 million. They want to deduct as much as they can, so the maximum 179 expense is 1,020,000. After that, there's still basis of 110,000 left. Then we'll look up at our, right, this is a machine, it's not fourth quarter, nothing fourth quarter that we know of, so we'll use the half-year convention table for 7-year property. The table should tell us 0.1429%. I can pull that up. Right, that half-year convention table, 7-year property, 14.29%, or 0.1429. Oh, here we go. All right, so that gives us on top of the 179. So in this column, I'm recording what do we actually get to deduct. So the 179 expense gets deducted, and the maker's depreciation on the remaining basis gets deducted for a total of $1,035,719. There's two limitations on 179 expense. It's supposed to be targeted at smaller businesses. And so once you put a certain amount of property in service during the year, you start to lose it. So for every dollar above 2,550,000 for 2019, goes up a little each year. If you were at 2,550,001 of property, you'd lose $1 from your maximum 179 expense. The other, right, and so once you were at 3,590,000, right, you would have come 570, sorry, you would have completely lost all 1,020,000 of the 179 expense, right, once you put that much property in service. Right, so if I'm a business and I bought a $5 million machine, I can't use 179 expense. I am too big. The other limitation on 179 expense is based on the business's taxable income. Taxable income counting everything except 179 expense. So it counts bonus depreciation that we'll talk about later. It counts maker's depreciation. Your taxable income with everything but 179, that's the most you can, 179 expense you can claim in the year. What this is saying, maybe this makes more sense. You can't use 179 expense to create a loss or to make a loss bigger, right? It can only reduce existing income. If you're phased out up here by your dollar amount of property, eligible property put in service, you just lose the deduction forever. If you're limited here by taxable income, whatever's limited can be carried forward. All right, so if I can still claim above this and carry the rest forward. If I do that, whatever amount of 179 expense I claim, even if I can't use it that year, it still reduces my basis. So that gets a little complicated. Let's say Brickman buys that first machine of 1.13 million. They also buy another one of 1.51 million. One was February, one was March. So they're both first quarter, so I'm going to use half-year convention. All right, so you can choose to apply the 179 expense to either machine, right, or both. Right, let's say they're going to choose to apply it to the first machine. Their original basis is that. All right, but now, because their total, I guess I didn't, I'm gonna skip down here. I guess I didn't show it. Yeah, didn't show it very good. All right, so my total, I'm just gonna close this so I can show you what we did here. What I'm doing is, oh no, I'm frozen. All right. I'm taking the combined totals of all the property eligible for 179 that I put in service. So that's 2,640,000. No, we're just jammed here. I'm just gonna write it down here so you can see. 2,640,000 is the total property, minus that threshold. Remember from the previous slide is 2,550,000. And that means I am over by $90,000 of excess. So that's how much I'm going to lose 90,000. So from my maximum, all right. From my maximum here of 1,020,000, right? That's just what the tax code says and the IRS says is the most for the year, minus the amount that got phased out because I had too much property. Now I'm down to 930,000. All right, so that's how I got to that 930 here because of the phase out. Okay. So after the 930 that I'm allowed, I have 200 of basis left. Then I'm going to use the regular rate of 14.29% times that 200,000. I can also deduct that on top of my 179 expense. And my total deduction is 958,580. All right, because my amount was reduced because of the amount of property placed in service, I just lose that 90,000 and there's no carry forward. All right, what if we go back to just having one machine, 1.13 million, so there's gonna be no phase out. But we also know that their taxable income before 179 expense is $300,000. That means the most 179 expense that they can claim this year is 300,000. That's their income, right? They can't create a loss. They can only bring it down to zero. What they could do, this is a little complicated. I won't get too tricky about this on the exam, but just to teach you probably a couple homework problems that want you to do this is, I can elect the maximum still, but I only get to deduct 300,000 because of my taxable income. But I have to keep track that I elected the maximum because that's going to bring my basis down. And that basis, will determine how much maker's depreciation I get on top of, same rate coming from the table, but now I'm using this basis after 179, So my total deduction is this, Why have I taken this out of my basis? Because even though I don't get that other 720,000, I can carry it forward because I elected it. Now next year, I can get this if I have enough taxable income, or the year after, etc. All right, so that's as much as we're going to do a 179 expense. Hey, that's plenty, right? There's a lot happening. Bonus depreciation. Bonus depreciation is going to be at least for the next couple of years. Really simple, because the rate on bonus depreciation is 100%. All right, so you can take this bonus depreciation of 100% of your basis on property. It could be new or used, tangible personal property. It could even be certain software. It can be a water utility property, This is where the lobbyists, know Congress is thinking of something. Everyone's getting in there. Qualified film, television, and live theatrical productions. All right, and so this slide still says with a useful life of, this is accurate, sorry, with a useful life of 20 years or less, and placed in service from September 2017 right? This is when they passed the law, basically, or a little before, through December 31st, 2022, right? So for this period of about 5 years, there's 100% bonus depreciation. And it starts to go down by 20% each year until it's gone in 2027, right? As of right now. So the way it's written is that if you don't do anything, you get bonus depreciation of 100%. If you don't want to take it, for example, maybe you just don't have income to reduce, then you have to affirmatively elect not to take it, right? You have to file a form and you have to check that you don't want to take bonus. If you do have bonus depreciation, let's say on furniture, that's 7-year property, then any other 7-year property that I placed in service that year, I also have to use bonus. Same if I elect out of bonus, I have to elect out for that whole class, right? All my 7-year or 5-year property. So those are kind of the complicated things, but right, in practice, most of the time, then bonus depreciation is incredibly simple. Right, this is just kind of the history. Don't worry about this. You're right. I went through. This is Oprah saying, you get a bonus, you get a bonus, you get a bonus, right? Thank you, Congress. All right, so let's go back to our example of Brickman. They bought that machine, $1,130,000. What can they deduct in 2019? They can deduct 100% of it. 1,130,000. They've, right, completely, right, sorry, this down here should say 2019. I'll just fix that real quick. Right? So bonus depreciation is incredibly simple. And right, nice if you're the taxpayer. Right, companies can do 179 and bonus, right? So they could do 179 first, if you remember. So if we take the maximum, all right, I got another typo here. 1,130,000, right? Minus that is, yeah. No, you see, now I'm off. Okay. $130 minus 20 is 110, right? And then the 110 times the maker's rate will be 15,719. Oh, sorry, no, I don't have to worry about that. All right, if I was more savvy or diligent, I would edit out my mistakes from the video. Just keep it real. All right, so they could elect the maximum 179 expense. They would still have some basis left. They could take 100% bonus depreciation on that basis, and now they've depreciated everything. Right, so so if I'm you and I'm doing a depreciation problem on the exam and the asset, all right, if some problems will say ignore bonus depreciation, ignore 179, you'll do that, right? If it says they just want to take the maximum deduction that they can, I just take, and it's an eligible piece of property, I would just take bonus depreciation on the whole thing and I'm done. All right, so if you notice, the main thing where I can't use bonus and I can't use 179 is, right, just standard real estate. So if I buy a building, I can't use any of these immediate expensing. I just have to use makers. Right? Real estate is so right? The numbers are big and it's already kind of a giveaway that you can depreciate it at all. All right, so there's no bonus for 179 on real estate. Most other things you can. Anna is the proprietor of a small business. In 2019, her business income before any 179 deduction will be $400,000. She buys new equipment for $2 million and furniture for $300,000. If she does not elect out of bonus depreciation, determine her total cost recovery. Right? I mean, we can look up the recovery period, but right, both of these, right, this is tangible personal property used in a business. Right? Just take 100% bonus depreciation and she's going to deduct everything, right? She's going to recover her basis in the first year. Right? And so this assumes that she has enough income, right? If she doesn't have this much income, then the deduction might not be valuable for her. And those are the cases where she might not take the full amount of bonus or 179. All right, so what if her taxable income is only 400,000, but she claimed that much bonus depreciation? Right, so there are limits on how much of a loss you can claim in a year, and right, and the rest you have to carry forward, and maybe you won't be able to use it, right? So she could use 179 expense, right? Because this bonus has to apply to all of her assets that are 7-year assets, or if it's 5-year, all of her 5-year assets. So maybe she just wants to use 179 because she could target it just at one asset, and she can just choose the number that she wants up to 1,020,000. So she could just take, for example, 179 expense on the furniture, and right, or she could take just 400,000 on the other one. What was the other one? Machine or whatever it was, right? She could bring her income down to 0. All right, so there was a drafting error where qualified real estate improvements weren't eligible for bonus. Right, the Republicans just made a mistake when they drafted it, and the Democrats didn't want to let them fix their mistake. And so there was, but right, with the stimulus passed for the coronavirus last week, this is fixed, right? So you can ignore this statement. Qualified real estate improvements, right? Things like I put a new kitchen in my restaurant. They are eligible for bonus now, right? So it makes it extra simple for you guys. It's just actual real estate, right? Buying a building itself that's not eligible for bonus or 179. All right, so next we want to talk about automobile, right? So there's this idea that somebody shouldn't, right? You can deduct your business vehicle. There's this idea you shouldn't be able to deduct a luxury car, right? It's viewed as a tax subsidy for a luxury car when a simpler car would have worked just fine, right? Such as a Chrysler Sebring convertible. Luxury, I mean, that's definitely a luxury car. All right, so Congress basically just puts a cap on how much depreciation you can deduct for a car. So you can see for 2019, you can only deduct $10,100 in year 1, $16,100 in year 2, $9,700 year 3. After that, $5,760. On top of that, you can also do bonus depreciation of $8,000. So really the most you could deduct on a car, right? Bonus has to be in year 1. The most you could deduct would be $18,100. You can deduct 179 expense on cars, but it counts towards your limit. So it doesn't usually make sense, or you don't usually get any benefit. So these limits, right, were put in place a long time ago. They apply to cars that weigh less than 6,000 pounds. For trucks, vans, and SUVs that weigh more than 6,000 pounds, right, which is most large SUVs, right, most trucks, these limits don't apply. The only limit on those, right? So you can do bonus depreciation on those. You can do the full maker's rate. The only limitation is you can only do $25,500 of 179 expense, right? But this year, since you can do bonus on the whole thing, that doesn't matter. Where am I at? These limits also apply to trucks and vans that are under 6,000 pounds. Right, but most of trucks and vans or larger SUVs are over 6,000 pounds. All right, so if John Q. taxpayer is thinking about a sensible yet bold Toyota Camry or a brand new full-size truck, this Camry is going to be, right, subject to those limits because it's a car weighing less than 6,000 pounds. Because the truck is more than 6,000 pounds, he could claim bonus depreciation on the entire amount, right? And so from a tax perspective, it might make more sense, right, to buy the larger vehicle even though he doesn't need it. Right? So it's kind of a strange quirk in the tax code because those weight limits were set a long time ago. And right, American car companies, right, most of their money comes from trucks and SUVs, right? So they also don't want that to change. All right, let's say John does buy the car. All right, right, even tax-wise, he would have got more deductions with the truck, right? But there's non-tax reasons, right? And it's still money he has to pay. The deduction doesn't make it free. So a car has a 5-year recovery period. His initial basis is $28,000. He's electing to deduct actual expenses instead of mileage. So how much depreciation could he deduct for 2019? Assuming he won't do 179 expense. We'll always assume that on a car. Remember, you can do 8,000 of bonus for a car under 6,000 pounds. That means he'll take that out and his remaining basis is 20,000. So for a car, right, cars are 5-year property. This wasn't in the fourth quarter. So we'll use the half-year convention, 5-year, 20%. All right, so 20% times his initial basis is $4,000. If we look back at those limits, his max would have been 10,100 of maker's depreciation. So he's under the limit. He's fine. So he can deduct the bonus plus his maker's depreciation. He can deduct $12,000 for the car. It's still a pretty big deduction. What if he bought instead a Porsche 911 for $90,000 and placed it in service in March for his business? How much can he deduct? Right, he could still elect a bonus of $8,000. His remaining basis becomes $82,000. Right, same rate for cars or 5-year property, half-year convention, 20%, gives him a deduction of $16,400. But, right, if you remember, let's go back, sorry. The most you can do for year one is $10,100. So since with the Porsche now, right, it's a luxury car, he's over the limit. All he can do is he can still do the bonus. He's limited to the max auto depreciation. His deduction will be $18,100. Don't remember what I was doing here. All right, so this the point here, right, trying to simplify things, right, of us going online. You won't be tested on this year. This is just showing you a case where you might want to you could use 179, right? If you're under the limits for a car, you could use 179 to bring yourself up to the max, right, for the year. Right, he can use 179 to get up to 10,100 with the makers and then add 8,000 of bonus. That's just, don't worry too much about that. Okay, a car is an example of what we call listed property. These are things that Congress says are especially susceptible to people using them for personal use reasons and calling them a business asset, right? So things like, it's tempting for me to buy a business car and deduct it, even though I mostly use it for personal. Same with, right, cell phones, planes, cameras. These are all called listed property, right? Because they're considered susceptible to abuse, there's special rules. All right, so if you have, you're going to calculate depreciation under normal rules, but you have to multiply it by the business use percentage. So if I only use something 60% of the time for business, 40% personal, I only get 60% of the depreciation, right? So if I use it, if it's mainly business more than 50% of the time, I just do everything normal. I can do any bonus that I'm eligible for, 179. I'll use the regular makers, accelerated double declining balance, but I just have to multiply that at the end times my business percentage. If the property is used less than 50% or equal to 50% for business, then I have to use an alternate rules that are much more strict. So the alternative depreciation system, ADS, says now I don't get the accelerated depreciation, I have to use straight line, and I can't use 179 or bonus, no immediate expensing. All right, so I'm going to use that alternative system, and then I'm still going to multiply it by the business use percentage. All right, Congress is saying nope. All right, so Jessica, suppose, buys a camera for $4,000, used it 20% of the time for business. Right, so now we're just going to use straight line. A camera has a 5-year life. So each year, 1 year's depreciation would be $800, right? Since we're not using our main accelerated tables, I have to apply the half-year convention myself. So half of that is 400, and then I multiply it by the business use percentage, 20% in this problem. So she can only deduct $80. If somebody used one of these listed properties most of the time for, right, more than 50% business, 1 year or 2 years, but then in a future year, they go less than 50%, they'll have to go back and recalculate all the prior years under this more strict system, right? And then they might even have income, right? If the difference is big enough, right? For time constraints, we're not going to do that. We're going to either be all the way in one system or the other. You won't have to go back, but for your information. John buys a car for $28,000. He uses it 60% of the time for business, right? All right, so when it's like this, unlike the camera in our last example, if it's more than 50% business, right, then, right, he could do, whatever, he can use 179 or bonus, like I did on that one slide. He could get up to the max of 18,100. He can do all that even though it's listed property and he uses it for personal use sometimes. But since it's more than 50% business, he can get the full benefit, but he just multiplies it times his business use percentage at the end. So times 60% will bring it down to 10,860. All right, so depletion is what we use for natural resources. Right, things like oil, gas, gold, silver, coal, titanium, all right, all of these, timber, all these things, right, produced naturally by the earth that we just harvest with our labor. So there's two methods you can use. One is cost, right? We're basically going to determine, right, what's our basis in the resource and how much do we expect to extract. Then we can assign $1 per unit, and we'll take the units extracted in a year times that $1 per unit. That's our depletion for the year. Right? It's pretty intuitive. If you underestimate and, right, you've recovered your full basis, but you're still extracting more units, then you can keep deducting depreciation under our other method, the percentage depletion. All right, so let's do a quick example of cost depletion. Scrap Happy wants to make their own paper, so they buy a tract of forest land, which they plan to use to harvest trees and make paper. They paid $75,000 for the property. $15,000 is the land. $60,000 is the timber on the land. They estimate that they'll get 30,000 board feet of timber. So we'll just take their basis, the amount that they paid for the timber, divided by their estimated total units, gives us $2 per foot. So if they were able to harvest 10,000 board feet during the first year, they'll just take that 10,000 times the $2 per foot that we got. Their depletion deduction will be $20,000, right? Right, and all right, so that reduces their basis in the timber. The other method is percentage depletion. Now, companies can use cost or percentage, and they can just use whichever one gives them a bigger number. So there's some pretty favorable tax rules sometimes for these natural resource companies, right? Mining and oil and gas, et cetera, right? At least under the federal. They're also subject to a bunch of different state and local taxes. All right, so the percentage depletion, you're just gonna look up a percentage from the IRS tables. We usually use this little exhibit from the book, right? So if I'm extracting asphalt, I'll use 14%, right? You can see that comes straight from the tax code. So I'll take that percentage times the gross income from that resource. But it's gonna be limited to 50% of their taxable income before depletion expense. And once again, I can calculate percentage and cost and use whichever one is bigger. Suppose Wilson had gross income from sales of titanium from his mine. His gross income was $300,000, taxable income $120,000. So first of all, I'll just say, okay, titanium has a rate of 22% times 300,000 is $66,000. But I'm limited to 50% of his taxable income before depletion, which is 120,000 is his taxable income. 50% of that is 60,000. That's my max. This is bigger than 60,000, so I'm limited to 60,000. Under the percentage depletion method, his deduction will be 60,000. And once again, even if you've recovered your full basis, you can continue to deduct percentage depletion as long as you keep extracting the resource. Okay, so we're going to quickly go through some rules for recovering the cost of intangible assets. So we call that amortization. One category is called Section 197. That's where I buy a group of assets from another party or another business, right? I acquire a bunch of assets for a lump sum. Section 197 exists because companies would try to manipulate how they allocated the cost so that they could recover it faster. 197 says if you acquire assets like that, you just have to recover the cost of all of them over 180 months, which is 15 years. The convention for intangible assets is almost always one we haven't seen. It's the full month convention. So if I acquire these assets in March, I get all of March and the rest of the year. So I would get 10 months out of 12. And another intangible asset or intangible costs that I can recover is organizational expenditures and startup costs. So these are things that a business might do before they're actually operating as a business. Organizational expenditures are available for partnerships and corporations, things like attorney's fees to draft a partnership agreement or articles of incorporation, legal costs, basically. Startup costs are ordinary and necessary business expenses I incur before my business is actually out there offering goods and services. Right? So maybe I'm paying wages to employees while I train them. I'm doing market research before I open my restaurant, things like that. So for these things, for each one, you can recover $5,000 you can deduct in year one. The rest you have to amortize over 180 months, just like the 197 intangibles. These costs, right, the amount you can deduct in the first year start to phase out. So once your startup costs go over 50,000, for each dollar above 50,000, you lose $1 of what you can deduct in the first year. All right, and it has to be amortized, right? Capitalized and amortized instead. The same thing applies to organizational expenditures. For every dollar above 50,000, you lose $1 of what you can deduct immediately in the first year. Suppose Aaliyah spent $12,000 researching the best location for his new bicycle repair business and training employees before opening. How much can he deduct? He can deduct $5,000 in that year. The other $7,000 he'll capitalize and amortize a straight line basis over 180 months. If he had spent $53,000 on those things instead, now because he's above 50,000, above that threshold by $3,000, he gets phased out of 3,000 of immediate expensing. So 5,000 is the most you can do in year one. He loses that 3 because his costs were too high, and now he's down to 2,000. So he'll deduct 2,000 in year one. The remaining, sorry, this is a typo. The remaining 51,000 will be capitalized and amortized straight line over 180 months. So something I think I didn't explicitly mention at the beginning, intangible assets get deducted on a straight line basis. Research and experimentation, right, AKA R&D, you can elect to either deduct these immediately, right, as you incur them, or maybe a lot of companies with R&D don't have income yet, so they'd like to capitalize them and amortize them, right, over straight line over 60 months or more. They can elect to do that instead. Tax reform put more limits if that research is conducted outside of the US. All right, patents and copyrights. If you purchase a patent or copyright from someone else, you amortize the cost of it over the remaining life of the patent or the copyright. If you self-create a patent, you also amortize it, right? All of the costs that it took you to develop that patent and the legal cost to get it patented, that becomes your basis. You amortize it over the shorter of the legal life, right? When the patent expires or the useful life. Maybe, right, a new drug or technology is going to come out before your patent expires, so my amortization period will be shorter. All right, so that's our intangible assets, right? Because of time constraints, we're kind of keeping it very brief on those, right? So that's chapter 10. All right, people generally find chapter 10, right? It's pretty straightforward, so it's not too bad.